Wyckoff suggests markets follow a perpetual cycle: price depreciation from high supply and low demand, and price appreciation from high demand and low supply. Essentially, market movement is a battle between supply and demand. The Wyckoff Method states that by observing these cycles in real time, traders can position themselves for successful trades. To track this battle, the theory defines 4 specific phases for monitoring supply and demand. These 4 phases are known as accumulation, markup, distribution, and markdown. Let's examine each of these phases, beginning with accumulation. So accumulation is a phase where buyers are starting to accumulate orders. It's where demand is overpowering the market, and it looks like this. It's pretty much a sideways market that is followed by a drive to the upside. Following the accumulation phase, the markup phase begins. This is characterized by buyers seizing control of the market, leading to a clear period of price appreciation. It manifests as a strong push to the upside, representing a profitable trend for buyers and establishing a definite bullish direction in the market. The distribution phase occurs when sellers begin unloading their positions into the market. It's essentially the opposite of accumulation, a period where supply starts to dominate demand. Visually, it often appears as a sideways range that eventually transitions into a move downward. And, as you might have guessed, the markdown phase is when sellers fully take control of the market, leading to a clear decline in price. It represents the selling phase, the downward movement that follows the distribution stage. According to Wyckoff, the market essentially operates within 4 repeating phases. Here's an illustration of how a typical market structure appears based on his theory. And if you examine almost any price chart, you'll notice they tend to follow this same general pattern. We start with accumulation phases, where buyers are building positions and absorbing available supply. This is followed by markup phases, as buyers push prices higher once selling pressure diminishes. Next come the distribution phases, sideways movements, where sellers begin regaining control. These are then succeeded by markdown phases, where the market declines before eventually transitioning again into either another accumulation or a reversal phase. In essence, buying and selling in the market represent a constant battle between demand and supply. When buying pressure outweighs selling, meaning demand exceeds supply, we see accumulation and upward price movement. Conversely, when selling pressure dominates, supply exceeding demand, distribution and downward movement occur. The Wyckoff phases of accumulation, distribution, markup, and markdown help traders identify and align with the winning side of this ongoing market battle. So how do we actually apply this in practice? We do it using Wyckoff schematics. These schematics allow us to visualize the Wyckoff method on a real chart and execute based on the concepts and analysis we've discussed so far. Here's an example of what an accumulation phase typically looks like. Whether you're viewing a line chart or a candlestick chart, this is the general pattern traders look for when applying the Wyckoff approach. To give you a quick overview, since it may seem a bit complicated at first, let's break it down. Essentially, this phase represents the point where sellers begin to lose control, and buyers start stepping in to regain dominance in the market. This phase marks the moment when buyers begin to firmly take control of the market, while selling pressure gradually weakens and fades. This move, known as the spring, represents the final push downward by sellers before buyers completely take over and drive the market upward. This transition gives rise to a sign of strength, signaling the beginning of the markup phase. From a market psychology standpoint, this schematic illustrates the pivotal moment when control shifts from sellers to buyers, leading to a new wave of upward price action. The beauty of this theory lies in its realism. It closely mirrors how the market truly behaves. Through Wyckoff's framework, we gain valuable insight into market psychology simply by observing the chart. However, there's one major drawback. In my opinion, and in the view of many others, it's simply too complex. Take a look at this schematic. Are we realistically expected to spot all of this unfolding in real time and execute trades without getting confused? There's an overwhelming amount of detail and too many minor movements to monitor if we're trying to trade strictly based on Wyckoff schematics. It's easy to get tangled up in the schematics. You can buy too early or too late, miss the move entirely, and ultimately find it extremely difficult to execute consistently. Quite honestly, It doesn't need to be this complicated. Trading doesn't have to be this hard. The good news is that the core concepts of Wyckoff can be applied in a much simpler, more practical way. So, the question is, how do we tackle this complexity? The answer is simple. We simplify the Wyckoff schematics. Instead of analyzing an accumulation phase with all its confusing elements and countless minor movements, we can simplify it and view it like this. Essentially, it's the same concept, but now we don't have to track every tiny swing or detail individually. To make this practical, we'll walk through the process from start to finish, showing how this simplified view highlights accumulation and what key signals to look for on the charts. Let's start with the markdown phase. Since a markdown is, by definition, a downward move, it naturally occurs before a standard accumulation. We'll cover reaccumulations later. In a typical accumulation setup, the pattern begins with a markdown, a period of declining price action that sets the stage for buyers to step in. Next, we look for a range. This range represents the selling climax and marks the main accumulation phase in action. At this stage, two things are clear. First, the preceding markdown demonstrates seller control. Second, the selling climax and accumulation range show buyers stepping in and matching the seller's strength. This is crucial because it's the first point after the markdown where buying and selling are roughly balanced. While we don't have a confirmed sign of strength yet, it's evident that sellers are losing their ability to push prices lower and are now in a relatively even battle with the buyers. The next key element is the spring. The spring represents the seller's final attempt to push prices lower. It typically breaks below the low of the selling climax, and the accumulation range. For the spring to be confirmed, it must be followed by a sign of strength, signaling that buyers are taking control. The sign of strength is an upward move that closes above the selling climax and accumulation range. Together, the spring and the sign of strength demonstrate a clear shift of control to the buyers. We see sellers dominating during the markdown, buyers stepping in during the selling climax and accumulation range, and then sellers making one final push in the spring. The sign of strength confirms that buyers have overcome all the selling pressure, closing the market above the previous highs of the selling climax and accumulation range. This clearly shows that the buyers have now taken control and shifted the market trend upward. Following on from the sign of strength, we would then see a pullback. That pullback is what we want to use as a buying point, giving us the best possible entry for our positions. Then, once we have the trade, we can run through the markup, which follows the accumulation, and that will be our profitable move into new highs. That's exactly where the profit from a position based on an accumulation schematic comes from. To break it down, there are only 5 steps you need to identify. Step 1 is the creation of the range. Here, we want to see the market move from the markdown phase into a sideways range. Step 2 is the sweep of the range, where the lows of that range are taken out. Step 3 is the breakout of the range, marked by a reversal to the upside and a close above the high following the sweep. Number 4, we want to see a pullback, which is where we want to buy with the best possible risk to reward. And then step 5 leads into the profitable markup, where we actually capture the gains from our accumulation trade. This provides a simplified perspective on the Wyckoff method. The same approach applies to distribution as well. Instead of trying to follow the complex distribution schematic with all its different elements and individual price movements, we can simplify it to essentially the same structure we just went through, but flipped upside down. When we look at a distribution, the pattern follows a similar logic, but in reverse. We start with the markup phase, followed by the buying climax and distribution range. Next comes the sweep or spring, where the market takes out the high of the buying climax, then a reversal that closes beneath the range. This is the sign of weakness. After that, we wait for the pullback to sell, leading into the profitable markdown. In this sequence, the markup shows buying strength. The buying climax demonstrates sellers stepping in with comparable power. The spring is the final push higher from buyers. The sign of weakness marks a complete shift of control to sellers. And finally, the pullback and markdown are where the actual profits are captured. Now it's time to look at some real examples on candlestick charts. And that's exactly what we're going to do. We'll go through an example that isn't perfect, because in real markets, setups are rarely flawless. The goal here is to help you develop an eye for the theory, so that you can apply it even when the market is messy or irregular. We start with a markdown phase, a clear downtrend. As price moves lower, we see a sell-off toward a recent low. At this point, the selling begins to slow, and the market transitions into a sideways range. Identifying this area gives us the markdown phase, followed by an accumulation or selling climax range. If we were to mark it out based on our simplified schematic, we'd have the initial sell move, and then the sideways range representing accumulation. The next thing we'd want to see is a sweep, a break of the low of this range, which validates the next step in the accumulation. In this example, that would be the low of the selling climax range. So now, if we move the market forward, we see a push downward. At this stage, it could be considered a sweep, but it's not confirmed yet. To confirm it, we would need to see the price push back above the range. Realistically, we'd want to see the market return above this high. For this example, I'd even say that just breaking above the structural high could signal a change in trend and a move back to the upside. But to be the safest and clearest, we'll wait for a full, significant break to see if this sweep turns into a bullish move. So far, the movement we've observed is moving in the right direction. Markdown, selling climax, sweep down to the current price area, and now we're looking for the sign of strength. Once that happens, we have the full sequence: markdown, accumulation, sweep, and then a break of structure showing the sign of strength. Next, we want to see the market pull back to a buy point, so we can get the best possible risk to reward. After an accumulation, whether you use the simplified or standard Wyckoff schematic, a pullback before buying is typical. Buying at the high would result in poor risk to reward if your stop loss is below the low, and setting your stop locally carries low odds of a successful trade because the market tends to pull back after significant moves. Personally, I like to identify buy points using supply and demand zones. For a buy setup, we're looking at a demand zone, a consolidation area before an upward move. In this example, this consolidation would represent our demand zone. For identifying the buy point, I typically use the sideways candle, the last candle before the impulse move. Then we had this upward move, and the market pulled back, retesting this zone and creating a new demand zone, which would realistically be just around here. Once again, I focus on the last candle before the impulse. As you can see, the market came back and retested this one as well, and this is what we call an efficient range. The market generally is not going to return to efficient ranges, and if it does return to an efficient range, meaning if we were to get closures in this area, we would then likely take out the low. I like to use the last imbalanced demand zone. This is basically how I would enter any trade I take, or use a supply zone for a distribution trade if we were trading the other way. For the stop loss, we want to clear some of the efficient range and make sure our stop is at least underneath. I would say this wick is a good place. You could go all the way underneath the low if you wanted to, but the main idea is that if the market were to close into this efficient range, the likelihood of the trade winning is very, very slim. The market is likely to continue through, so we have to give some room for wicks. For example, if it wicks underneath like this, or wicks a couple of times, but we don't really need to leave room for significant closures. If the market closes inside the efficient range, we accept the outcome, take the loss, and move on. This way, the loss is minimized. Buying from the buy point once the market has pulled back is a great way to execute, and using demand zones is an effective method for that. For the stop loss, it's obviously placed under the low if possible. If the risk-reward ratio is too poor, place it underneath some of the wicks inside an efficient range like this, to ensure clearance for any wicks that occur. This allows you to exit with a controlled loss if the market closes into the efficient range, without letting the loss become too large. For targets, of course, you can set them up wherever makes sense. For this trade, we'll place it at this wick here. This approach gives a clear framework for entering, managing risk, and setting targets, while respecting the principles of supply and demand and the efficient range concept. So now we can clearly see our accumulation phase. On a larger time frame, this is actually part of an even bigger phase of accumulation, with the market moving within a wider range. From here, we would expect a break of structure, a pullback, and then a buy. Up to this point, we've been focusing on the more confined range of accumulation, followed by the sweep, the sign of strength, and now we're identifying our buy point down here. After that, we anticipate the markup phase. If we play this forward, we can see that, in this simplified approach, we don't need to account for every single element of Wyckoff. We're not labeling every point or tracking each individual price movement. Instead, we're simply following the overarching market cycle concepts of accumulation, distribution, markup, and markdown. In this example, the market moves toward the target, which in this instance represents roughly a 5% gain on a 1% risk. The underlying idea and concept hold true. We applied the market cycle theory: markdown, accumulation, spring, sign of strength, buy point, and markup, but in a simplified way. All we needed to focus on was the flow of the market: consolidation, break beneath, break above, closure, pullback, and then buy. This simplified schematic allowed us to execute the trade effectively while still using the core Wyckoff concepts. Following that trade, we can now observe the market moving into its next phase, which is a style of distribution. The previous markup phase has flattened out, meaning the market had clear buying control, but now it's entering a phase where seller and buyer control are roughly equal. We may see small breaks, but these don't lead to anything immediately because a sweep hasn't occurred yet. Here, we can see the sweep beginning to form. Ideally, what we want is for the market to move below the range and then pull back, providing a selling opportunity. As the market comes down toward the low, we see our first sign of weakness. This is our sweep. At this point, we have the second and third phases of distribution in action: the sweep itself and the first sign of weakness according to Wyckoff. It's worth noting that personally, I avoid entering trades without closures beneath key levels. Wicks may show rejection, and while trades sometimes work out, I prefer to wait for another close below the level followed by a pullback. In this instance, the sell-off occurs, but it looks like we may not get the pullback. As a result, this particular distribution opportunity would have been missed. Still, this example clearly highlights how the distribution phase continues to play out in the market, demonstrating the progression of Wyckoff concepts in a real-world scenario. Now, looking at a smaller time frame, we can see that the market may be moving into another phase of accumulation. We have the markdown, followed by the selling climax range. A spring forms down here, and now the market is coming back up, pushing above and closing above parts of the accumulation we identified earlier. Ideally, we would then want to see a pullback, followed by a continuation higher. That's the general concept we're looking for in this instance. You can also identify the buy point using a demand zone. Here, this consolidation acts as our demand zone, so the buy point would be within this area. The stop loss can be placed underneath the wicks, or under the low on this example, which may provide a better risk-reward ratio. Targets can be set wherever desired. For this example, we'll use the swing high as a target. What this shows is a natural market formation. Even though the accumulation here is a bit messy, it still exhibits all the characteristics of a simplified Wyckoff schematic. We also have a distribution phase that demonstrates these same concepts, though in this case, it wouldn't have been a trade I'd enter because it doesn't meet my rules. Accumulation, distribution, and Wyckoff theory are built around market psychology and price action. The time frame you trade really doesn't matter. For example, on a 30-minute chart, we can see a solid accumulation. On hourly charts, the same principles show clear accumulation and distribution. This demonstrates that whether you're trading higher or lower time frames, these concepts still apply and continue to work. With this understanding, you can remove the confusion and approach Wyckoff theory in a much simpler, more practical way.